and welcome to CNBC TV 18's crucial Citizens Monetary Policy Committee meeting. Crucial because the MPC will have to assess what may be the damage to growth near-term and long-term because of demonetization, what will be the consequent lowering of inflation, if any. Then they have to decide on the instruments, whether generous rate cuts are needed now and hereafter, and second, if surplus liquidity needs to be kept in the banking system. Remember, the last position was neutral liquidity from the Reserve Bank. Well, with these preliminaries, let me invite Chairman of the MPC, Dr. Pranab Sen. He's former advisor to the Planning Commission, former Chief Statistician and Chairman of the Statistics Commission. Sajid Chinoy, the Chief Economist at JP Morgan. Sonal Verma, the Economist at Nomura Financial Advisory. Soumya Kanti Ghosh, the Chief Economist at State Bank of India. And Samiran Chakraborty, the Chief Economist at Citi India. Gentlemen and lady, good morning and thank you very much for joining me. Dr. Sen, let me start with you, sir. Do you expect that you are assessing the impact of the demonetization to be rather severe on growth? Will that impinge on your decision whether to vote for a cut or not?
Well, you know, Lata, I find this whole thing completely bizarre. I mean, we are sitting and discussing monetary policy when all instruments of monetary policy are not working and will not work for a while. And today, I think we really need to shift our discussion a little bit and worry not just about the economy, but the fulcrum of all monetary stances, which is the banking sector, because my sense is that as we stand today, the entire banking sector in India is in default mode. And we are just lucky somebody has not taken them to court. So we really need to talk about what do we need to do in terms of RBI policy to make sure that the banking sector isn't in deep trouble. Rate cuts are a part of it, but I think one would have to pretty much stand the perspective on its head.
So you warned us last time as well about the precarious state of the banking sector's health, but go to court, why?
For the very simple reason that there is already a legal and technical run on all banks. While it is perfectly legitimate for the government to impose restrictions on withdrawals, if banks are unable to meet even the government-imposed limits, then the banks are in default. Government has said, and the courts have upheld, 24,000 rupees per week. Most banks are unable to meet even that need. So technically, every customer who is being turned away from the bank saying we don't have cash, for him the bank is a defaulter.
Yeah, I guess there were some legal experts even questioning whether such a limit can be placed. It's my money and I should be able to withdraw. Sonal, what's your assessment of the damage to the economy and what can the MPC do?
Well, I think the main question the MPC has to answer is whether they expect the demonetization to have a transitory effect on growth or a more permanent damage to the economy because of the wealth destruction that might happen as a result of this. I mean, at this stage, you know, the assessment is that it's more, and our view is that it's more of a short-term damage because of huge dependence of cash of various segments of the economy, whether it's agriculture, trade, construction, real estate, and the time it's going to take the Reserve Bank of India to really replenish the notes. So growth in the fourth quarter of calendar year, so the December quarter and the March quarter, our assessment is it's going to be at least percentage points, maybe between 1 and 1.5 percentage points lower. The reason we don't see this as a permanent growth damage is because it's actually turning out to be a scheme more of wealth redistribution, whether, you know, money is going into the banking accounts of the poor, the money that the government is going to get on account of the, you know, additional tax revenues, which it can use for infrastructure and rural sector spending, or the money that which was literally lying under the mattress, going to the banks, which can now be circulated back into the economy, and therefore, velocity of money picking up, and for more productive sectors. This is going to start showing up as well on growth, although with a lag. So it is a short-term growth disruption, a transitory disruption in our view, should not have a significant negative longer-term effects.
Okay. Okay, I'll just come to your recommended action in a bit. Shamiran, how much are you estimating growth to be cut?
Well, if you look at it, I quite agree with Sonal that it's more of a transitory thing than a permanent thing, unless this process of making an informal economy more formal, which increases efficiency but at the same time have an impact on employment. If this process, if you take it too far and too quickly, in fact, we know that GST is also going to come sometime soon, that can also add to the pressure, then it can become a bit more structural in nature, and the weakness can persist a little bit longer, which is not as yet our base case. Our base case is very similar to what Sonal was saying, about 150 basis point decline in the second half of the year.
Okay, before I come to your rate action, do you assess that the removal of probably 4 or 5 lakh crore of black money, while it has come back or may come back in the laundered version, some part of it at least, does it prevent, say, buying of luxury goods, conspicuous consumption, real estate deals, and therefore will that part lead to a slightly more longish impact on growth? Is FY18 growth in danger?
So as long as this money is coming back into the system, I don't see a reason why it cannot be used for consumption purposes, except for the fact that maybe there could be the shock and awe effect for a while, which might force people not to spend. There is an increased amount of uncertainty which can affect business spending as well. So I'm quite conscious about that, and maybe that can have a little bit of an impact on growth. But at this moment, the kind of decline in growth that we are seeing, that is more because of lack of cash in the system rather than anything else.
So you're not disturbing your FY18 numbers yet?
Not much. We have reduced it by about 40 basis points, but that's not simply because of this. It's more because of the other headwinds that, like GST, that we were anyway trying to bake in. At this moment, what we think is that some kind of an insurance rate cut can come in, which just says that, okay, we are aware of the decline in growth. This is something which is there just to support the economy a bit and keep the ammunition dry for more action if it is warranted at a later stage.
Okay. Well, Sajid, of course, I want to know how long you think the ripple effect can be. Let me shift the question, therefore, to inflation as well. Yes. If growth remains subdued for a longish bit, then are we looking at a totally different trajectory for inflation for FY18 from what you thought maybe 2 months back?
We're not. So we were of the opinion always that there was downside risks to the RBI's 5% forecast, and even before the demonetization had penciled in about 25 basis points of easing in the cycle. I think what this does is give the RBI a little more comfort that those downside risks exist or there aren't upside risks. I agree with Sonal completely that I think 3 weeks ago people worried about the wealth effect. What's the impact over the next couple of years? Now the concern is much more a liquidity constraint that is going to be binding for households. The question the MPC has to ask itself is 2 things. One is this a 1 to 2 quarter phenomenon, or is it 3 to 4 quarter phenomenon? If it's the latter, and pricing power doesn't exist for 3 or 4 quarters, then you have a more sustainable dampening effect on inflation expectations. So I think the space may be different depending on your assessment. The second is, we talk a lot about the demand shock. This is a negative demand shock, but is this also a supply shock? We've seen oil prices move up globally, and is there some impact on value chains or supply in the near to medium term? So I think these are the 2 assessments they have to make, which is that there are downside, in our view, downside risks to inflation that opens up some degree of easing. What that quantum is depends crucially on what you believe, whether this is a 2-quarter demand shock or a 4-quarter demand shock, because I think the latter will dampen inflation expectations. One other thing, Lata, we should not forget, this is being conducted in a very global turbulent global environment. We're so focused on the domestic factors here. You're seeing after the latest NFP number, 100% pricing of the US Fed raising rates in December. The dollar index has strengthened, oil prices have moved up, and after the Italian referendum there's more uncertainty in Europe. In this very turbulent global environment where the interest rate differential between US Treasuries and Indian 10-year G-Secs have narrowed by more than 120 basis points in 3 weeks, the question the RBI has to ask itself is, how comfortable are you, and in what sequence should one be cutting interest rates? I think that will, in a way, determine whether you want to front load some easing or stagger it out once more information is known domestically and internationally. The last thing I'll say is we've had one economy-wide data point since then, the manufacturing PMI, which came out late last week. If you look at the new order component, it's only 3 weeks of data in November. That fell quite meaningfully. This was the biggest drop in 4.5 years. So there are lots of moving pieces here, and I sympathize with the uncertainty that the MPC finds itself in at this meeting.
All right, I take your point, Sajid, about the global backdrop as well. But Soumya, we are really wanting to listen to what the biggest bank has to say. How deep is the hurt on both the banking front and on the economy front, according to you? Is this just a couple of quarters? Will things rebound?
See, I think it's very difficult to tell at this point of time because we are getting contradictory points from our grassroots. Let me give you the positive points first and possibly the negative points. The positive thing is that there are reports that there were some disruptions, for example, in cement dispatches or FMCG sales for the first couple of days. Then the sales have actually rebounded. So this is the first thing. The second thing is that some parts of the country were in fact hard that the pain is not too much. There has been some little pain. Yes, there has been disruptions, but not to the extent which the markets may tend us to believe. On the negative front, I think some of the sectors possibly could be a little bit, already has been a drag on the economy, for example, the real estate sector. And then also even though we have been listening positive news, the jewelry sector. And these are some of the sectors which has been doing badly, and that could actually act as a drag on the growth. So as of now, it's difficult to say what could be the impact of growth, but I am sure for this quarter, the growth could be actually impacted by anything upwards between 50 to 100 basis points. Second quarter, the only thing is how these deposits come back, because right now there is a withdrawal limit on the deposits which are entering the banking system. So once this withdrawal limit goes up, and even if you're assuming that an 80 to 85% withdrawal deposits, and even if you're assuming an 13 lakh crores of deposit comes through as a conservative estimate, so there could be an addition of 2 trillion to the banking system, which is a permanent injection in deposits in terms of the net liquidity. So this is going to be a big positive for the banks. So withdrawal rate, for example, for our banks, which was very low, less than 10% at the beginning, if we just take the pure withdrawal rate to the deposits which is coming to our bank, was close to around 45% or so at the end of November, which has inched up further. So my sense is that it will depend, the rebound will depend how quickly those deposits go out and the banks are able to make business opportunity out of it. My sense is that this figure could be in upwards of 80% if you look into the trends, which has been the historical trend.
The withdrawal will be 80%.
Yes, 85%. So the net deposits could be around 2 trillion crores or so on. In that case, the rebound in the next quarter could be a little bit on the higher side.
Okay, that's good to hear if it's as early as next quarter itself. Well, we quickly take a break and then we are going to discuss what the MPC will do on December 7th. Back in a minute. Welcome back to CNBC TV 18's Citizens Monetary Policy Committee. The committee is meeting at a very crucial point where they have to assess, without too much data at the moment, what is the longer-term impact of the demonetization and hence what monetary policy instruments to use. Well, Dr. Sen, you began by saying that you're more worried about the plight of banks. Keeping the plight of banks in mind and your possible long-term assessment, should the MPC recommend large doses of interest rate cut, or should they keep liquidity surplus?
Well, what is important is at the moment talking about liquidity is kind of meaningless. You're unable to replace the existing currency, so, who are you fooling? Number two, much more importantly, when we talk about rate cuts, I think we really have to widen our horizons a bit, because typically we just talk about the repo. I think we better start talking about the reverse repo at this stage. and even more importantly, the one deposit rate that's controlled, which is the savings bank rate. And frankly, my sense is that given the kind of impact that this whole thing is having on the banking system, the MPC should actually recommend a cut in the savings bank rate.
Well, actually, sir, the savings rate is deregulated, but most banks have not yet chosen to cut it much. It is a deregulated rate. But Dr. Sen, in your estimate, what is the longer-term impact on inflation? If growth has taken a knock, then would you say that FY18 we are staring at probably a half a percentage point lower inflation than you thought? Will it be sub 5, for instance, for a goodish bit?
Well, much will depend on how long the restrictions on withdrawals continue. The longer they stay, the lower and the longer will be the duration of reduced inflation. But if the liquidity is brought back and the withdrawal limits are gradually eased, then the supply side factors can kick in. And so I think on that I am in agreement with Sajid and Shaumiron that the supply side effects, we still don't quite know what's happening. But on the demand side, everything depends on the pace at which withdrawal limits are eased.
Okay. Well, over there we have too many unknown knowns, which is, what is the pace of currency printing, and especially the pace of currency printing of the 500 rupee note. Apparently, the entire capacity of printing is not fungible. And therefore, the 500 rupee notes could take a while in coming. And that, of course, will determine the withdrawal rate removal, withdrawal limit removal. Sonal, what is your sense? Are we going to get a lower inflation, and does that open up, even if not now, the longer-term elbow room to cut rates?
Well, does it lead to lower inflation? The evidence so far in November has definitely been that because of the transportation bottlenecks, perishable prices have come down quite substantially. Although, as far as the non-perishable prices are concerned, I don't think there's been a big fall, but perishable prices have come down. There's been a bigger decline in wholesale prices, to a lesser extent in retail prices. But on an aggregate, there has been some moderation in inflation, and therefore, the scope for front-loading the cut definitely exists. Beyond that, I think if this is indeed wealth redistribution, and I think the risk to this view in terms of whether this is a transitory or a prolonged impact is also to an extent will depend on what happens to the real estate market, because if this triggers a significant correction in real estate prices, then the wealth effect, the negative wealth effect could actually be much larger. But if this is more transitory, and like I said earlier, if this is more of a wealth distribution, and especially money going to the productive sectors, money going to the poorer segments of the economy, the marginal propensity to consume for those specific sectors actually tends to be much higher. So if that's the case, actually it might end up being more of a transitory effect on inflation rather than having a permanent impact. Having said that, I mean, over a period of time, if you do, cut down on corruption, etc., it should be disinflationary. But at this stage, we're not changing our longer-term growth forecast. It's more the nearer-term growth forecasts that have changed. And so to that extent, like I said, the scope of front-loading easing definitely does exist.
Okay. Well, Samiran, are we not, giving less importance to the global scenario? Like Sajid mentioned, crude is now in a different trajectory. Metals, even after the dollar index touched 102, we didn't see metals receding. So given this global backdrop, will inflation have a different color even if the domestic aggregate demand is lower?
Well, clearly, even before this event, we had our FY18 inflation forecast at a higher level than FY17, partly baking in the higher commodity price environment globally. But just if you look at this thing, I think three odd things apart from what we were already discussing are important. One is that what happens to the margin if this is making more informal economy formal, taking out more middlemen, maybe over the longer term it's good for inflation because the margin drops. The second thing is that, and that's completely on the opposite side, is if people start paying and collecting taxes, at some point of time they will have to pass it on to prices. Now, one does not know that at the current CPI data collection, whether the data is collected from people who are already paying taxes or not. But assuming that some part is collected from people who are not paying taxes, you might just see a spot in prices for them. So there are a lot more nuances to this inflation story than what we can predict as of today, just because the project that has been undertaken is such huge in its dimension that we should not be underestimating the longer term impact of those things as well.
Okay. Well, transmission. So first let me get to the biggest bank. If liquidity is, if the tone of the Reserve Bank is that liquidity is going to be neutral, banks will be wary of cutting rates further. As it is, this huge CRR penalty, so to speak, that came, as one banker said, has made my deposits an NPA. So, do you think, Soumya, the Reserve Bank needs to change its neutral stance, at least temporarily, and say it is surplus, simply because, you need to give growth that confidence, you need to give banks that confidence to transmit?
I think there are two stories playing out over here. One was the pre-demonetization, when there was a clear trend of transmitting to a lower interest rate regime, and the second is the post-demonetization. Now, what has happened is that, and these are all actually hypothetical assumptions, because nobody knows what is likely to be the deposit inflow at the end of the day. But even if we are assuming that in the normal course an 80 to 85% withdrawal rate, total amount of deposits which is coming back into the system is around 13 lakh crores, say, at the end of the day. So that means the bank will around 1.5 trillion or 2 trillion crores of liquidity at the end. So if we now impose a CRR, incremental CRR, SLR on that, and given the fact that 6 lakh crores have already been set as the MSS limit, I think right now the number is quite sufficient in terms of the liquidity withdrawal. So my first sense is that the RBI should need to give out a signal to the market that the incremental CRR is going to be phased out, or it's going to be totally phased out by this policy. Because one thing is that in the MCLR calculation, this incremental CRR has already made, and the contribution has doubled. So basically, whatever the banks could have benefited in terms of a cut in the deposits, that may have been neutralized by this incremental CRRI. So my sense is that once the RBI gives the signal that, well, this is we're going to phase this out, I think the banks will breathe a little easier. And so even though it may not say explicitly that we're going for a neutral liquidity, say surplus liquidity regime, but at least this message will assure the banks, and possibly that could set the rate for further rate cuts in the subsequent months.
Okay. Well, final thoughts from you before I take the MPC's vote. Sajid, you are not inclined to see inflation dip in FY18. What more should the MPC worry about? Health of banks, for instance?
No, so to start with, I think the first quarter, let's be careful about March. There's a negative adverse base effect in March. So March CPI can be closer to 5% than the average of the first quarter. Our sense is the first quarter's average is 4.5%, and our sense is the average over much of the next year, without the HRA increase, for example, is about 4.5%. So the sense is, between 4.5 and 5. So there is more, in my view, there's more comfort the RBI has that underlying inflation, adjusted for all the idiosyncrasies, is going to be consistently below 5%. In our view, that opens up, between 25 to 50 basis points of easing. It's really the MPC's choice to determine whether they want to front load it or wait for more information, see how domestic and global events pan out, and then stagger it. I'll just say one quick thing on transmission, Lata. I think there's a conceptual confusion on two issues here. One is, what are the choice of instruments the RBI has? And now that they have the MSS bonds, one can expect to see that the CRR will be rolled back, and you'll use the MSS and the assets on your balance sheet for reverse repo, and that should cover 13 trillion. But the other is, going into surplus means, do you want to take the call rate into the reverse repo rate? And I think that can be terribly confusing, create lots of uncertainty to a framework that markets have begun to understand. Just when liquidity was extremely tight for much of 2016, the RBI made sure that the call rate was towards the repo rate. Now we have the symmetrical opposite situation where liquidity is in surplus, and you don't want to confuse markets by making sure that the call rate's at the reverse repo rate. So I think what the RBI has done is the right thing to do. If you worry about growth for 3-4 quarters, cut the repo rate. But I don't believe growth can get a support, because for 3.5 weeks in December, the call rate's going to be at the reverse repo rate, right? That will do more damage to the signals the RBI sends out than it does help to any growth for 3 weeks on the ground. So I think bottom line is the RBI is not faced with an easy situation, and I think they've done the best they could, given the constraints they operate under.
Well, actually, Dr. Sen, after all, began the discussion by saying that, it is the uselessness of monetary policy instruments at this juncture. We really have to wait for normalcy to return before interest rates have an impact. At the moment, who's looking to borrow? That's the issue. But nevertheless, the MPC has to vote, and that's what it's going to do. Let me start with the lady first. Is there a cut or no cut, Sonal?
We think there'll be a cut.
All right. Samiran?
Yeah.
Oh, there is a cut. Sajid?
We expect a cut as well.
Okay.
So you
Saumya,
also expect a
there's
cut as well.
Dr. Sen, 4 are saying cut. What does the chairman say? Oh, chairman differs, sir. It's a hold. So, sir, I will not come to you in terms of how much, but let me start with Sonal. How much, Sonal?
25 basis points.
Okay, let's get to Samiran. Samiran, how much are you expecting? It's a 25 basis cut from Samiran as well. Sajid, your cut?
A baseline is 25. We won't be surprised with the 50.
Okay, but should I take the vote as 25?
25 is the baseline.
Okay. Well.
So we are factoring in 25, but will not be surprised if it goes to 50.
All right. So there are 2 people who would be okay with a 50 basis cut as well. The important point is the Monetary Policy Committee definitely expects a rate cut. The chairman is advising against it quite clearly because there are too many moving parts at this point in time, and a cut may not necessarily help because there is really no demand for credit. The second vote has come on the amount of cut. 2 people definitely expecting 25. The other 2 saying they won't be surprised if it is 50. So clearly market going in with a cut. But the important point is the MPC doesn't expect clarity from the Reserve Bank on growth as well. Too many moving parts, so everything that will be said about growth and inflation are likely to be extremely tentative. That's it from the Citizens Monetary Policy Committee of CNBC TV 18.